Welcome to today's lesson. Hello students, welcome to today's lesson, where we'll take another exciting step in your accounting journey. Today, we'll explore recording business transactions in a computerized accounting system. But before we dive into the practical part, there's something critical we need to cover first. We'll be focusing on sections 1.3 and 1.4 from Chapter 3 of your FIA FA1 book by BPP. These sections hold essential concepts that provide the foundation for understanding computerized accounting systems. Whether you're preparing for your exams or setting yourself up for a successful accounting career, this knowledge is indispensable. Why this lesson is so important? Before you can record transactions in a computerized system, it's essential to understand. 1. Section 1.3, Key Features of Computerized Accounting Systems. Learn about the controls in place to ensure accuracy and security. Understand standing data, which includes key information about customers, suppliers, and transactions that stays consistent over time. Familiarize yourself with account codes, which make the process of organizing and posting transactions more efficient. 2. Understand why businesses rely on accurate record keeping to track sales, expenses, customer balances, and profits. Learn how these processes help businesses plan, monitor, and make informed decisions for short and long-term success. How this knowledge helps you. These sections aren't just theory, they're your roadmap to mastering computerized accounting systems. Once you understand the features and requirements, you'll see how they make recording transactions quicker, more accurate, and more secure. Additionally, these topics may appear in your exams, so be extra careful and take your time to really absorb this information. Revisit this lesson if needed. It's better to fully understand it now than to struggle later. What's next? Once we've covered these foundational concepts, we'll move on to the practical part, where we'll actually record transactions in a computerized accounting system. This will include working with software to apply what we've learned. So, let's get started with sections 1.3 and 1.4. Listen carefully and don't forget to take notes. This knowledge is key to your progress and future success in accounting. What is a computerized accounting system? A computerized accounting system is software designed to record, manage, and report a business's financial transactions and data digitally. Unlike manual bookkeeping, where entries are written down by hand, computerized systems use automation to streamline processes like recording journal entries, maintaining ledgers, generating reports, and ensuring compliance with accounting standards. These systems come in various forms, ranging from basic software for small businesses to complex ERP, enterprise resource planning systems for larger organizations. Core features of a computerized accounting system. 1. Automation. Automates repetitive tasks like posting to ledgers, calculating totals, and generating financial statements. 2. Accuracy. Reduces human errors, ensuring more precise recording of transactions. 3. Integration. Combines all financial data in one place, such as sales, purchases, payroll, and taxes. 4. Scalability. Grows with the business, allowing the addition of more modules and accounts as needed. 5. Real-time data provides instant updates, so financial reports can be generated at any time with the latest information. Efficiency of computerized accounting systems. One of the biggest advantages of a computerized accounting system is its efficiency. Let's break it down step by step to see how these systems save time, minimize errors, and improve overall productivity. 1. Faster data entry. Transactions only need to be entered once into the system. After that, the software automatically posts them to all relevant accounts, saving time compared to manually recording each transaction in multiple ledgers. Example: a sale recorded in the sales account will automatically update the accounts receivable and cash bank accounts without additional input. 2. Real-time reporting. Computerized systems generate financial statements instantly, giving businesses immediate insight into their financial position. This is especially useful for decision-making. Example: A manager can pull up a profit and loss statement or a cash flow report at any time without waiting for accountants to compile data manually. 3. Accuracy and error reduction. By using predefined account codes, the system ensures that transactions are posted to the correct accounts. Automated calculations eliminate errors in arithmetic. Example: if a transaction is recorded in the wrong account in a manual system, correcting the mistake involves a lot of work. In a computerized system, it's a simple matter of editing the entry. 4. Simplified reconciliation. Matching bank statements with accounting records, a process known as bank reconciliation, is much faster in computerized systems. Many software programs can even link directly to bank accounts for automatic reconciliation. Example: the software will flag discrepancies between the recorded transactions and the bank statement, saving time on manual checks. Integration across departments. Computerized accounting systems can integrate with other software like inventory management, payroll, or customer relationship management systems. This creates a unified workflow. Example: when an invoice is issued through the sales module, the system automatically updates the accounts receivable, inventory, and revenue accounts. 6. Scalability and customization. As a business grows, computerized systems allow for the addition of new accounts, departments, or even multiple business locations without reworking the system. Example: a growing retail chain can add accounts for each new store to its existing system without disrupting ongoing operations. 7. Improved compliance. Computerized systems are programmed to comply with accounting regulations, tax laws, and reporting requirements. This reduces the risk of fines and penalties. Example: the system can automatically calculate V8 GST or income tax and generate the necessary reports for submission. 8. Security and backup. Data is often encrypted and backed up regularly to prevent loss or theft. Access controls can restrict who can view or edit specific information. Example: only authorized personnel can access sensitive accounts like payroll or taxes, ensuring data confidentiality. 9. Audit trails. Every transaction is logged with details like who entered it, when it was entered, and any subsequent modifications. This ensures transparency and makes audits easier. Example: an auditor can trace a single transaction back to its source document with just a few clicks. 10. Cost efficiency in the long run. While setting up a computerized accounting system requires an initial investment, it saves money in the long term by reducing labor costs, minimizing errors, and improving productivity. Example: automating payroll processing can eliminate the need for additional staff to manually calculate salaries and taxes. Key features of computerized accounting systems. Based on Section 1.3 of your FIA FA1 book by BPP, here are the key features of computerized accounting systems. Today, we'll dive into each of these features in detail, one by one, to fully understand how they work and why they're important. 1. Controls. These ensure that all data is recorded accurately and processed as expected. Built-in controls automatically check for errors, prevent unauthorized access, and verify the validity of transactions. They ensure the system operates efficiently and the records remain reliable. 2. Standing data. This refers to data that doesn't change frequently, such as customer and supplier information, sales tax rates, or agreed payment terms. Once entered into the system, this data is reused for transactions and only updated when necessary. It eliminates repetitive data entry and reduces the risk of errors. 3. Account codes. Every account in the general ledger is assigned a unique code to make categorization and posting of transactions efficient. These codes simplify identifying accounts like sales, rent expenses, or supplier payments. Account codes are particularly helpful for tracking transactions and ensuring accuracy in reports. Understanding these features will give you a strong foundation in using computerized accounting systems. Let's now move into each feature step by step. Controls in computerized accounting systems. When it comes to computerized accounting systems, controls are an essential feature. Controls are mechanisms, processes, or checks built into the system to ensure that all the data entered is accurate, complete, and secure. These controls are like security guards for your accounting records. They make sure everything works as intended and prevent errors, fraud, or misuse. Let's break this down step by step. What are controls? Controls are built-in features within the accounting software that monitor, check, and restrict how data is entered and processed. These controls protect the system in several ways. 1. Accuracy. Ensures that data entered is correct. 2. Completeness. Makes sure no transaction or information is missing. 3. Authorization. Restricts access to sensitive areas of the system, so only authorized users can make changes. 4. Consistency. Makes sure that all data follows predefined rules or formats. Types of controls in computerized accounting systems. 1. Input controls. Input controls ensure that the information being entered into the system is correct and in the proper format. They are designed to minimize human errors during data entry. Examples: mandatory fields. Certain fields, such as the transaction date or invoice number, cannot be left blank. This prevents incomplete records. Validation rules. If you try to enter text into a numeric field, e.g. a dollar amount, the system will display an error message. Drop-down menus. Instead of typing out customer names, you might choose from a drop-down menu. This reduces spelling mistakes or mismatches. Duplicate entry checks. The system alerts you if you accidentally try to enter the same invoice twice. Scenario. Imagine you're entering a sales invoice for Neelam Sultan's florist business. The system checks that the date is valid, e.g. December 32 is flagged as invalid. The total invoice amount matches the sum of individual items listed. The customer name is selected from an existing list to avoid creating duplicate customer records. 2. Processing controls. These controls ensure that data entered into the system is processed correctly and doesn't get corrupted during calculations or postings. Examples: automatic calculations. For example, if you enter the quantity and price of an item, the system automatically calculates the total amount, e.g., 10 items at $5 each equals $50. Batch totals. If multiple transactions are entered at once, the system checks that the sum of the totals entered matches the sum of the processed transactions. Audit trails. Every change made to a transaction is recorded, showing who made the change, what was changed, and when it was changed. Scenario. If Neelam records 5 invoices totaling $1,000, the system compares the entered total with the calculated total. If they don't match, it flags the error. 3. Access controls. Access controls ensure that only authorized users can access certain parts of the accounting system. This is especially important for sensitive financial information. Examples: role-based permissions. A sales clerk may only be allowed to create sales invoices, while the accountant has access to the bank reconciliation module. Password protection. Each user needs a secure password to log into the system. Approval levels. High-value transactions may require manager approval before being processed. Scenario. In Neelam's business, the cashier can enter daily sales transactions, but only Neelam herself can approve payments to suppliers or view profit reports. 4. Output controls. These ensure that the reports and summaries generated by the system are accurate and complete. They check that the information presented is reliable for decision-making. Examples: reconciliation reports. The system generates a report to compare recorded cash with actual bank balances. Error logs. If something goes wrong, e.g. a missing data field, the system flags it in an error log for review. Summary reports. These reports are reviewed to confirm that totals match across different sections of the accounts. Scenario. When Neelam runs a report to see her monthly sales, the system ensures that all transactions recorded for the month are included and nothing is left out. 5. Preventive controls. These controls stop mistakes or fraud before they happen. Examples: preset spending limits. The system may prevent a payment that exceeds a certain amount without special authorization. Segregation of duties. A user who enters invoices cannot also approve payments for those invoices. Locked periods. Once a month's accounts are closed, the system prevents further changes to those records. Scenario. If Neelam tries to process a payment for a supplier that exceeds her company's spending limit, the system blocks the payment and sends a request for her approval. 6. Detective controls. Detective controls identify errors or issues after they've occurred so they can be corrected. Examples. Bank reconciliation. Compares the bank statement with recorded transactions to spot discrepancies. Exception reports. Highlights unusual activities, such as unusually large discounts given to customers. Trial balances. Detects when total debits don't match total credits. Scenario. Neelam's accountant notices that the trial balance for December is off by $50. The system highlights this discrepancy, prompting the accountant to review the journal entries. Why are controls important? Accuracy. They ensure the financial records are correct and free of errors. Security. They protect sensitive financial data from unauthorized access. Compliance. They help businesses follow accounting laws and standards. Efficiency. They reduce the time spent fixing mistakes and streamlining processes. Fraud prevention. They prevent dishonest employees from tampering with the records. Real-life example of controls in action. Imagine Neelam Sultan has hired an employee to handle daily sales transactions. Without controls, the employee could 1. Enter incorrect sales amounts, leading to inaccurate financial reports. 2. Process unauthorized refunds to themselves or friends. 3. Forget to record some sales entirely. However, with controls in place, the system validates all sales entries and ensures they match inventory records. Any refund requires Neelam's approval. All transactions are time-stamped and recorded in an audit trail. This way, Neelam can confidently manage her business, knowing the system is protecting her financial records. Conclusion. Controls are the backbone of any computerized accounting system. They ensure that transactions are handled accurately, securely, and efficiently. By preventing errors, fraud, and misuse, controls help businesses like Neelam Sultan's florist shop focus on growth without worrying about financial inaccuracies. Remember, good controls mean good business. Understanding standing data in computerized accounting systems. Standing data refers to the essential information stored within a computerized accounting system that does not change frequently. Think of standing data as the static information that forms the backbone of the accounting system. It's always there and is only updated occasionally. This data helps automate transactions and ensures accuracy and consistency in the system. Let's break it down step by step and look at examples to make it clear and relatable. What is standing data? Standing data is the core information about the business, its customers, suppliers, and products, which is entered into the system when the software is set up or when there are updates, like adding a new supplier or customer. This data is not part of day-to-day transactions, but it provides the foundation for those transactions to be recorded accurately. Types of standing data. 1. Customer information. Details about the business customers are stored in the system, allowing quick and accurate invoicing, credit tracking, and customer relationship management. Examples: customer name, Green Garden Supplies; address, 123 Floral Street, Springfield; contact details, email and phone number; credit terms, payment due in 30 days; sales tax registration number if applicable; agreed discounts, 5% off for orders above $1,000. Scenario: when Neelam Sultan sells flowers to Green Garden Supplies, her system automatically fills in the customer's details, such as their name, address, and payment terms, ensuring she doesn't have to re-enter this data for every sale. 2. Supplier information. Information about suppliers is recorded to streamline purchasing and payment processes. Examples: supplier name, Bloom Wholesale Distributors; address, 45 Plant Avenue, downtown; contact details, phone number and email; bank account details for processing payments; agreed terms, payment due in 60 days. Scenario: When Neelam orders floral supplies from Bloom Wholesale Distributors, her system uses the stored standing data to ensure the supplier's address is printed on the purchase order and payment terms are followed. 3. Inventory or product information. Details about the products or services that the business sells or purchases are stored. Examples: product name, rose bouquets. Product code, RB001. Unit price, $25 per bouquet. Description: freshly arranged roses in decorative wrapping. Reorder level: notify when stock falls below 20 bouquets. Scenario: when Neelam creates a sales invoice for rose bouquets, the system automatically retrieves the product code and price, ensuring the invoice is accurate and no manual entry mistakes occur. 4. Tax rates and rules. The system stores information about applicable taxes, such as sales tax or value-added tax, VAT. Examples: sales tax rate, 10%. Exempt customers or products. Educational institutions are exempt from sales tax. Scenario: when Neelam sells flowers to a school, the system knows to exclude sales tax based on the stored standing data about tax exemptions. 5. Employee information. In businesses with payroll processing, employee details may also be part of the standing data. Examples: employee name, Sarah Flores. Job title, delivery driver. Hourly rate, $15 per hour. Bank account details for salary payments. Tax codes for payroll deductions. Scenario: when processing payroll, the system uses the stored hourly rate and tax code to calculate Sarah's salary and deductions accurately. 6. Business-specific information. Details about the business itself are stored and used in documents like invoices, purchase orders, and financial reports. Examples: business name, Sultan's Florist. Address, 10 Bloom Lane, Springfield. Business registration number. Bank account details for receiving payments. Logo, included on all printed invoices. Scenario: when Neelam sends out an invoice, the system automatically includes her business name, address, and logo without needing manual input each time. Why is standing data important? 1. Saves time. Since standing data is stored in the system, it eliminates the need to re-enter the same information repeatedly. For example, customer details are automatically filled in when creating a sales invoice. 2. Ensures accuracy. By using pre-entered data, errors are minimized. For example, if Neelam's supplier's bank details are stored, she won't accidentally send a payment to the wrong account. 3. Improves efficiency. Automating processes like generating invoices, purchase orders, or payroll reduces workload and allows businesses to focus on other tasks. 4. Consistency across transactions. Standing data ensures that customer names, product codes, and tax rates are consistent across all transactions. This reduces confusion and improves professional reporting. How is standing data used? Sales transactions. When a sale is made, the system pulls customer details, product descriptions, and tax rates from standing data to create an accurate invoice. Purchase orders. When buying supplies, the system uses supplier details and inventory information to generate purchase orders quickly. Payroll processing. Employee details stored as standing data are used to calculate salaries and deductions. When does standing data need updates? Standing data is generally static, but may require updates under the following circumstances. 1. Customer or supplier changes. A customer moves to a new address, or a supplier changes their payment terms. 2. Price updates. The price of a product increases or decreases. 3. Tax changes. The government announces a new tax rate. 4. New employees or products. A new hire joins the team, or a new product is added to the inventory. Example of standing data in action. Let's say Neelam Sultan receives a phone order for 50 rose bouquets from Green Garden Supplies. 1. Neelam opens her accounting system and creates a new sales invoice. 2. The system automatically fills in Green Garden Supplies address and payment terms, the price and product code for rose bouquets, the applicable sales tax rate. 3. Neelam only has to confirm the quantity, 50, and the system calculates the total amount due. This process takes just a few clicks thanks to the stored standing data. Conclusion. Standing data is like the foundation of a well-built house. It ensures the system runs smoothly, accurately, and efficiently. While it doesn't change often, it plays a crucial role in automating transactions and maintaining consistency. By keeping standing data updated and accurate, businesses like Niam Sultan's Florist Shop can save time, avoid errors, and focus on what matters most, serving their customers and growing their business. Understanding the chart of accounts and account codes. Before we learn about account codes, let's first talk about the chart of accounts. These two things are closely connected and form the foundation of any accounting system. What is a chart of accounts? A chart of accounts, COA, is like a detailed list of all the accounts a business uses to record its financial transactions. Think of it as a directory or filing system that organizes every transaction into categories like income, expenses, assets, liabilities, or equity. The purpose of the chart of accounts is simple: to make sure every financial transaction is recorded in the right place, to help the business easily track and report its financial health. Example of a chart of accounts: assets, cash, inventory, equipment; liabilities, loans payable, accounts payable; income, sales revenue, service revenue; expenses, rent, salaries, utilities. Each account in the chart of accounts is given a unique identifier or number, which is where account codes come in. What are account codes? Account codes are special numbers or letters assigned to each account in the chart of accounts. They act like short names for the accounts, making it quicker and easier to record financial transactions. Think of account codes as labels that help you direct transactions to the correct place in the accounting system. Example: instead of writing cash account, you could just use the code 1010. For rent expense, you might use the code 5010. Why are account codes important? Account codes are very helpful because they, 1, keep things accurate. They make sure transactions go to the right account. 2, save time. Instead of typing the full account name, you just enter the code. 3, help computers work better. Accounting software relies on codes to sort and organize transactions automatically. How do account codes work? Businesses often use a numbering system to organize account codes. Accounts are grouped into categories, and each category is given a range of numbers. Example of account code ranges: assets, 1,000 to 1,999. Liabilities, 2,000 to 2,999. Equity, 3,000 to 3,999. Income, 4,000 to 4,999. Expenses, 5,000 to 5,999. Within these ranges, each specific account is given a unique code. Example of specific account codes: cash account, 1010. Accounts receivable, 1020. Sales revenue, 4010. Rent expense, 5010. How are account codes assigned? Step 1. Decide the category first. Figure out if the account is an asset, liability, income, expense, or equity. For example, cash is an asset and rent is an expense. Step 2. Pick a number range. Next, choose a number within the range for that category. For example, assets might start at 1,000, so cash could be 1010. Expenses might start at 5,000, so rent could be 5010. Step 3. Make sure the code is unique. Every account needs its own unique code. For example, cash account might be 1010. Accounts receivable might be 1020. Why use account codes? 1. Speeds up data entry. Instead of typing rent expense each time, you just type 5010. 2. Prevents mistakes. Each account has its own unique code, so there's less chance of putting a transaction in the wrong place. 3. Makes reporting easier. When accounts are organized by codes, it's simple to group similar transactions for reports. For example, all income accounts, 4,000 to 4,999, can be grouped together in one report. Examples of account codes in action: Example 1. Recording a sale. Let's say a florist sells flowers for $500. The transaction would involve sales revenue account, code 4010. This is credited because income has increased. Cash account, code 1010. This is debited because cash has increased. Example 2. Paying rent. The florist pays $1,000 for rent. The transaction would involve rent expense account, code 5010. This is debited because expenses have increased. Cash account, code 1010. This is credited because cash has decreased. Accessing computerized accounting systems. Accessing a computerized accounting system depends on how the software is set up and deployed within an organization. Broadly speaking, there are two main ways businesses access such systems: locally installed software or cloud-based solutions. Each method has its own features, advantages, and limitations. Let's go through both approaches in detail. 1. Locally installed software. In this setup, the accounting software is installed directly on the computers or servers within the company's premises. This means the system operates entirely offline unless the company adds network connectivity for data sharing. How it works. Installation. The software is purchased and physically installed on the computers of the accounting team or company servers. Access. Employees access the software through local drives or via a network within the company. Storage. All financial data is stored on the company's computers or servers. Advantages of locally installed systems. 1. Control. The business has full control over its financial data since everything is stored in-house. This is especially important for companies with strict data privacy policies. 2. Security. Because the data isn't stored online, it's not exposed to potential internet-based threats like hacking or breaches. 3. Offline access. Users can work even when there is no internet connection, ensuring uninterrupted operations. Example. Imagine a mid-sized retail company that uses locally installed accounting software. The company has its accounting department access the software through its internal network. Only authorized staff can log in, and all data is stored securely on the company's own servers. Challenges. 1. Maintenance. The business is responsible for maintaining the software, updating it, and ensuring that backups are made. 2. Cost. Initial costs can be high since the business must purchase the software license and potentially invest in dedicated servers. 3. Limited access. Employees can only access the software from devices connected to the company's network. Cloud-based accounting systems. Cloud-based systems, often referred to as cloud accounting, operate differently. Here, the accounting software and all the data are hosted on remote servers managed by a service provider. Users access the system via the internet, similar to logging into an email account. How it works. Hosting. The software and data are stored on the service provider's servers. Access. Users log in using a web browser or dedicated application on their devices. Connectivity. An internet connection is required to use the software and access data. Advantages of cloud-based systems. 1. Remote access. Users can access the system from anywhere with an internet connection, making it ideal for businesses with remote teams or multiple locations. 2. Automatic updates. The software provider manages all updates, ensuring that users always have access to the latest features and security measures. 3. Data backup. Data is automatically backed up on the provider's servers, reducing the risk of data loss due to hardware failures or natural disasters. 4. Scalability. Cloud systems can easily grow with the business, allowing companies to add more users or modules as needed. Example. Imagine a startup company that uses a cloud-based accounting software like QuickBooks Online. The owner, working from home, can access the system to check financial reports, while the accountant, working in the office, can simultaneously input transactions, all in real time. Challenges. 1. Dependence on internet. If the internet connection is slow or unavailable, users may face difficulties accessing the system. 2. Data privacy concerns. Some businesses worry about storing sensitive financial information on external servers. 3. Subscription costs. Cloud-based systems often operate on a subscription model, which may become expensive over time. Key differences between locally installed and cloud-based accounting systems. This chart highlights the main differences between locally installed systems, software installed directly on company computers, and cloud-based systems, software accessed via the internet. Let's go over each aspect step by step. 1. Access. Locally installed, access is limited to the company network. This means you can only use the software when you're physically connected to the company's computers or internal network. Cloud-based, the system can be accessed from anywhere as long as you have an internet connection. This makes it ideal for remote work or accessing data on the go. 2. Data storage. Locally installed. All data is stored on the company's own servers or computers. This gives the business full control over its information. Cloud-based, data is stored on the servers of the service provider, often located in remote data centers. The business depends on the provider for secure storage. 3. Cost. Locally installed. These systems generally have a high upfront cost because the business must purchase licenses, hardware, and infrastructure. However, ongoing costs tend to be lower since there are no recurring subscription fees. Cloud-based. These systems typically have lower initial costs because they operate on a subscription model. However, the business will need to pay recurring subscription fees, which can add up over time. 4. Maintenance. Locally installed. The company is responsible for handling all updates, backups, and hardware maintenance. This requires technical expertise and time. Cloud-based. The service provider takes care of all updates, backups, and system maintenance, saving the business time and effort. 5. Security. Locally installed. Security is fully controlled by the business. The company is responsible for implementing and maintaining firewalls, encryption, and other protective measures. Cloud-based. Security is managed by the service provider. While most providers have robust security protocols, the business must trust the provider to protect its data. Why is this important? Understanding how computerized accounting systems are accessed helps businesses choose the right system for their needs. For example, a small business with a tight budget may prefer a cloud-based solution because of its low upfront costs. A large corporation with high data security needs might opt for locally installed software to maintain full control over its data. Conclusion. Both locally installed and cloud-based accounting systems have their unique strengths. Modern businesses often prefer cloud-based systems for their flexibility and ease of use. However, for companies prioritizing control and offline functionality, locally installed systems remain a viable option. Regardless of the choice, both systems aim to streamline accounting processes, reduce manual effort, and provide real-time insights into a company's financial health. Business requirements in accounting. In accounting, every business needs to maintain accurate and up-to-date records to stay on top of its financial situation. These records don't just fulfill legal or regulatory requirements. They also provide vital information that helps a business operate efficiently, make informed decisions, and plan for the future. Let's break this down into simpler terms and explain why accurate record keeping, summarizing, and posting transactions are essential for meeting a business's requirements. What information does a business need? Here are the key types of information businesses rely on. 1. Sales of goods and services by volume and value. A business must know how much it has sold, both in terms of quantity, volume, and money earned, value. Example, if a store sells 100 chairs in a month at $50 each, it needs to track both the 100 units sold, volume, and the $5,000 earned, value. This information is crucial for assessing performance, planning inventory, and setting sales targets. 2. Expenditure incurred. This refers to all the money a business spends, whether it's on rent, salaries, raw materials, or utilities. Example, a bakery spends $1,000 on flour and sugar this month. Knowing this helps the business see where its money is going and control costs. Tracking expenses ensures the business doesn't overspend and maintains profitability. 3. Amounts owed by customers. When a business sells goods or services on credit, it needs to know how much money is owed by its customers. Trade receivables. Example, a car dealership sells a car for $20,000, but allows the buyer to pay in installments. The business needs to track how much the customer still owes. Without this, businesses might forget to collect payments or run into cash flow problems. 4. Amounts due to suppliers. On the flip side, businesses often buy goods or services on credit and owe money to their suppliers. Trade payables. Example, a clothing store orders $5,000 worth of stock but agrees to pay the supplier after 30 days. The business needs to record and monitor this liability. Keeping track of payables ensures the business doesn't miss payment deadlines and maintains good relationships with suppliers. 5. Cash and bank balances. Every business needs to know how much cash it has on hand and in its bank accounts at any given time. Example, a business may have $2,000 in cash and $10,000 in its bank account. This information helps with daily operations and ensures the business has enough funds to cover expenses. Monitoring cash flow is crucial for avoiding overdrafts or running out of money. 6. Profits and/or losses made over a period. Ultimately, a business needs to know whether it is making money, profit, or losing money, loss over a specific time, such as a month or a year. Example, if a business earns $50,000 in sales but spends $40,000 on costs, it has a profit of $10,000. If the costs exceed sales, it's operating at a loss. Profit and loss information guides long-term decisions like whether to expand, cut costs, or raise prices. Why is this information important? When all this information is put together, it helps the business. 1. Plan for the future. Businesses can forecast how much they'll earn or spend in the coming months and prepare accordingly. For example, if sales are expected to increase, they might order more stock or hire more staff. 2. Monitor performance. By reviewing sales, expenses, and profit figures, businesses can see what's working and what isn't. If expenses are too high, they can look for ways to cut costs. If sales are low, they might adjust their pricing or marketing strategy. 3. Make informed decisions. Financial data helps businesses decide things like whether to take out a loan, invest in new equipment, or open a new location. For instance, knowing how much cash is available might help a business decide whether it can afford to buy a new delivery van. 4. Ensure long-term success. Accurate records help businesses avoid financial problems, like overspending or forgetting to collect money owed by customers. This strengthens their financial health and keeps them competitive. In simple terms, accurate record keeping is like keeping a personal diary for the business's money, where it comes from, where it goes, and how much is left. This financial diary ensures the business operates smoothly and makes smart decisions for both the short term and the long term. By the end of this chapter, you'll understand how to record, summarize, and use this information effectively to meet these essential business requirements. Thank you, students, for joining today's lesson. We hope you found it informative and engaging. If you enjoyed the session or found it helpful, please take a moment to like the video and subscribe to the channel to stay updated on future lessons. Your support means a lot and helps us continue bringing you valuable content. See you in the next lesson. Until then, take care and keep learning.